In today's Perspective video, we're going to be talking about financial resilience.
Nowadays, our world is more complex and globalized than ever before. It's exposed to technological disruptions, and all of that lead to the fact that we need financial stability. But this is also the thing that is the most fragile in the current state. Individuals, but also institutions, often struggle in adapting to this fast-changing world. We have to keep in mind that the markets are hyper-connected, a phenomenon that we're observing just right now.
Financial resilience is not just narrowly defined as an emergency drill. So the first important element is the actors, could be the consumers, could be the individuals, investors or traders. And the second important element will be the environment, that could be the market, trading institutions, societies and communities. And the last part is the government policies and regulations that are meant to smoothen the interactions between the actors and the environment.
We are primarily interested in the question of how we can design policies and systems that would help individuals better deal with potential disruptions and shocks and bounce back, but not only to come back to the previous level, but also exceed it. Financial resilience has 4 pillars. It consists of economic resources, financial knowledge and ability to use that knowledge, so financial skills, the access to financial services, and the social component. So it's basically the links in the society in which we are embedded.
Financial resilience is not only about having enough money. The first thing is the tools that individuals can get access to, understanding the behaviors of individuals. So they have to do self-reflections on their financial habit and their financial knowledge.
Finance is a glue between social and psychological aspect. Finance is the enabling factor for societies to grow, but also to connect and to build networks and to develop. But to understand financial resilience, we actually have to understand human behavior. That's why psychology and behavior are really key components of financial resilience. We also found that there are some psychological factors, such as personality traits, that also make some individuals be more financially resilient. We were looking at some culture differences because we did our studies in both Singapore and in Switzerland. We also look at the impact of technology on financial resilience. And what we find is that people who use more Fintech, so people who use e-wallets or other technological applications, they're already much more financially resilient because they are more informed about the different tools that they could use. So the differences in financial resilience between Singapore and Switzerland comes mainly from the system in which the society is embedded. In our research, we also created a tool that we call the Zurich Trading Simulator. We use that tool to investigate some real-life situations that we observe in finance. One example is social trading. Social trading is a situation in which we combine social media in a trading platform. So it's a platform that allows traders, investors to observe the strategies of others, and it also allows them to copy the strategy of those performance that they fancy. And what is most important, it puts the best performing traders in the spotlight. There were 3 key findings from our study. First of all, we found that seeing those super performers that usually appear in the spotlight makes investors take more risk. Second of all, they are more active, so they make more trades overall. But at the same time, this doesn't lead to better financial outcomes, and it contributes to their lower satisfaction with their own performance in their trading. Another example by using the same tool was when we were recording body reaction to the anticipatory emotions while people were trading. So we recorded people's skin conductivity, that is micro-sweating of our skin that reflects arousal, such as attention. And we found that people who earn in the market bubble and crash scenarios, they were actually predicting with their attention, with their body reaction, the next market movement. these findings are very important for the future of investing. Maybe we'll be able to improve our trading and investment behavior using tools like sensors. Another part of our research is devoted to human behavior and interaction with crypto markets. Crypto markets are very interesting because they are designed to be decentralized and unregulated. But at the same time, because they are growing and becoming increasingly popular, there's a rising question: should we regulate it? And if we do this, how should we do this to best protect the users and the customers and the traders in those markets?
We witness increasingly investors get access to sophisticated technologies in the form of algorithm. Retail investor would not have the capacity, would not have access to algorithmic bots, so they can be disadvantaged. So the question here is, should regulation comes in to protect the interests of retail investors? So what kind of regulations? In our study, what happens if we create a speed bump, so essentially slowing down the speed of the algorithm? One example is a market order algorithm, so where the system is automatically observe the market. Whenever there is a good price to buy, then the system will prompt immediately, so there is a buying decision there. When it is a good time to sell, then algorithmic bot will take actions for the interest of the retail traders. The answer is not always clear-cut. Of course, we cannot prevent innovation and technology from happening, so algorithmic bot will be here with us. How can we mitigate this impact on the retail traders? That's the important questions. Dark pools are private exchanges. It's called dark because there's no transparency there. What will be the bid price and what will be the ask price? In dark pools, we don't see all of this because these are private, so private exchanges. Think of large investors. So they want to buy a huge amount of shares. If they have to go through the stock exchange where everything is visible, their actions can signal to the market, and that can destabilize the markets. So dark pools in a way allow them to shield themselves from these unwanted consequences, and that has a big influence on the stability of the market. Nowadays, there are a lot of innovation in the financial market. And innovations are good. This is the sign of progress. But at the same time, we need to be able to evaluate the impact of these innovations. With regulation, we can fine-tune the innovations to the betterment of the whole society.
Financial resilience is not only about dealing with crisis. That's also about building resilience for the everyday life. That's about sustainability and socially stable communities that live financially healthy life. We should promote sustainable and responsible and informed use of financial tools and new technology. And we should also promote financial literacy to build more financially resilient societies.